Hey everyone, welcome to this explainer. Today we're diving straight into the massive macroeconomic ripple effects of that May 15th US-China summit. You know, the one between President Trump and President Xi over at the Zhongnan High Leadership Compound in Beijing. Look, if you're tracking global finance, trade, or infrastructure, you already know how huge this is. We're going to cut right to the chase, unpack exactly what went down, look at the real-world global impacts, and figure out what we should be expecting next.
So, let's get right to the bottom line up front. You know, a lot of times these diplomatic summits are, well, just pageantry, right? Lots of photos, not a lot of substance. But this one was actually different. Both leaders locked in a 3-year truce built around this exact phrase right here: constructive strategic stability. President Xi specifically noted they've agreed to a totally new positioning of their relationship. And honestly, this is a massive deal. It acts as a much-needed buffer against all that market volatility we've seen during past trade standoffs. It literally sets a brand new tone for global markets.
To cut through the noise today, we're breaking this explainer down into 4 quick parts. First, we'll look at this new strategic stability. Then, capital and commodity commitments. Third, stabilizing global energy markets. And finally, we'll wrap up with the macroeconomic forecast.
All right, let's jump right into Section 1, a new strategic stability.
Okay, so this whole concept of de-risking is absolutely foundational to everything we're talking about today. Basically, what we're seeing is Washington and Beijing looking at each other and saying, okay, let's pivot. They are mutually agreeing to a 3-year new positioning and intentionally stepping away from that cycle of decoupled escalation. And guys, this is a critical inflection point. By pulling back from the edge of just endless volatility, these two superpowers are giving global markets the breathing room they desperately need. It's a chance to actually refocus on growth, tech integration, and real structural economic development. Both sides clearly see the mutual economic damage of constant volatility, and they are choosing a totally different path for now.
Moving right along, here is Section 2, capital and commodity commitments. Now, the sheer scale of the immediate deliverables we saw is just staggering. Take a look at this number, 200. China has officially agreed to buy 200 Boeing jets. I mean, just think about the ripple effect of an order that massive. We're not just talking about a simple transaction here. This is a gigantic capital injection straight into the veins of the U.S. aerospace manufacturing sector. It just perfectly highlights this incredibly pragmatic, highly transactional stabilization of what is arguably the world's most important bilateral relationship.
But wait, because the trade commitments absolutely do not stop at aviation. To pragmatically tackle those ongoing trade imbalances we all know about, the U.S. secured some really substantial, tangible commitments. We're talking expected double-digit billions, yes, billions with a B, in U.S. agricultural sales. That means a massive influx of soybean purchases for sure. And right alongside that agricultural boom, we're seeing renewed Chinese interest in buying U.S. oil. These are hard, physical commodity commitments that are going to completely alter the supply chain calculus for the next 3 years.
Which brings us to Section 3, stabilizing global energy markets. And honestly, this just brilliantly illustrates the stakes here. Check out that 20% slice. Roughly a fifth of the entire world's oil supply typically flows right through the Strait of Hormuz. Now, because of the ongoing conflict, the closure, and all that surrounding instability at this critical choke point, it has baked a massive geopolitical risk premium into both crude oil and industrial metals. So the absolute blockbuster news from this summit is that both leaders have come out and expressed a shared mutual desire to end the conflict and finally get this vital strait reopened. The real-world implications of this are huge. The U.S. is essentially expressing confidence that China will pragmatically limit their material support to Tehran. Because of that, we're basically shifting our entire outlook from an environment just choked with heavy inflationary risk premiums over to a much more predictable, coordinated stabilization of global energy flows. Look, if you're an executive managing complex supply chain logistics, physical infrastructure, or cross-border capital, this coordinated superpower effort is a profoundly bullish signal. It's essentially taking the immediate threat of huge, energy-driven inflationary spikes right off the table.
All right, let's bring it all together in Section 4, the macroeconomic forecast.
So what's the immediate forecast? Well, it strongly points to a cooling-off period, really driven by high-level engagements and carefully managed competition. To keep this newly minted stability actually stable, they've laid out a really clear roadmap of state visits. In September, we're expecting President Xi to make a reciprocal visit to the U.S. Then, fast forward to November, President Trump is slated to head over to the APEC meeting in Shenzhen. And to wrap up the year in December, President Xi will be in Miami for the G20. This whole calendar of face-to-face, highly managed engagements is purposefully designed to keep the guardrails firmly in place on this 3-year truce. Now, of course, any objective analysis means we have to look at the ongoing flashpoints, right? While this summit definitely secured some major economic breakthroughs, Taiwan remains the absolute core of China's interests. That being said, U.S. Secretary of State Marco Rubio was very clear in confirming that U.S. policy on Taiwan remains entirely unchanged. So the fundamental disagreements, yeah, they definitely persist. But the big takeaway for us today is that both administrations are clearly, at least for now, prioritizing economic stabilization over military brinkmanship in the Strait.
So, what's the bottom line for how markets are going to react as we head into the second half of 2026? Well, based on all these developments, you can absolutely expect equity markets, especially in these three key sectors, logistics, agriculture, and aviation, to confidently price in this newly de-risked environment. I mean, think about it. Predictable energy flows, massive agricultural purchases, and truly historic aerospace orders. The landscape for long-term capital allocation in these specific areas has just drastically improved.
Wow, okay, we've covered a lot of ground today. Everything from massive capital injections in aerospace to stabilizing the world's most critical oil choke points. But as you go back to update your models and map out your future capital allocations, just remember, sustained monitoring of how these purchasing agreements actually play out in the real world is going to be absolutely essential. Which leaves us with one final, totally vital question to ponder. Will this 3-year constructive strategic stability actually hold firm and reshape global trade? Or are we just looking at a temporary, highly transactional pause in this era of superpower competition? You're definitely going to want to keep a close eye on those delivery metrics in the coming months. Thanks so much for joining me for this explainer, and I'll catch you next time.